It's always it's always great to have, even when we have a small group on the live session, because you guys get an exclusive to be able to ask questions along the way and even at the end. So please take advantage of the time. For anybody that might be watching on the excuse me, on the video later, feel free to reach out to us or your advisors with any questions. In any case, I'm glad you can join us. I want to thank you in advance, Craig, for your time. It's a pleasure to see you again. I know it's been a bit, but I know we have a lot of communications by email and electronically, and your company continues to provide a lot of great information and resources for us and our advisors that we utilize still as part of the core investment strategy for our financial planning process. In particular, the dividend component, balanced dividend on the Yield Select strategy, which I still call it Yield Select. I know it's been a while, maybe since you guys called it that, but we go back a long way, and it's genuinely my pleasure to have this special guest, Columbus Macro, Craig Columbus, here presenting for us today. We don't have the slides, so I want to mention, because I will need to for compliance purposes, that today's presentation shouldn't be construed as advice of any kind. Please be sure to refer back to your advisors prior to acting upon any information, whoever that may be. So with that, Craig, I'm going to turn it over to you. Always a pleasure to have your insight and knowledge. I know you've got a lot of it, and we really miss these conversations. But if you share your thoughts on what you think might be great to know about in terms of either what's taking place in the markets this year and maybe what you see up ahead, also possibly in the economy, the election, and maybe a little information about your company and your strategy that you run for us, that'd be great.
Well, it's so good to see you. We have had such a great long-standing relationship. It's been just an honor to work with you all over the years and serve you. You could not, I think, asked for a more interesting time for me to come on. You asked at the end of June, and who would have known that July is just a fascinating month. So I'm so glad we got together at this time. I say fascinating because these kind of two great macro events aligned to produce a real change in markets. And those two events would be, the first is inflation data continued to cool. So we have had 3 consecutive months of cooling inflation data, CPI, PCE. And that increased the likelihood of a Fed rate cut in September. Fed is meeting today and tomorrow, likely to project their first rate cut in September. Remember, the Fed has been on hold since last summer. It went through this hiking cycle, stopped hiking last year in July, and it's basically been on hold with this restrictive monetary policy. So that's a big deal. The odds of a rate cut this year soared based on cooling inflation. And the second thing was we had a real shift in the political landscape. First, there was the debate. Then there was an assassination attempt, and then there was a Republican National Convention. And the prospects, which were largely leaning one direction, tilted the board more in the other direction. Markets responded. And then obviously the change of Mr. Biden dropping out, and now a new candidate has reshuffled the board of those election dynamics even more. But those events together really caused a rotation in the market, which I think is fascinating. So 2 topics: politics and economy, and we'll treat them separately. So we'll talk about politics first. And earlier in my life, I was a strategist, and knew Chris from my prior life. And so my beat, part of talking and writing and speaking about the economy and doing it for CNBC and other places, was to predict elections. And I had a kind of I guess you'd say, a pretty good track record of predicting elections. From really, my first was Gore Bush in 2000, and all the way through Biden, Trump in 20, had predicted them all correctly. And it wasn't because I have any great skill in politics, but it really goes back to what Mr. Reagan said on the last debate, with the Carter-Reagan debate. Mr. Reagan famously said to the audience, are you better off than you were 4 years ago? And that's an economic question, right? Or if you want to fast forward into 1992, Carville said, is the economy stupid? And when you study elections all around the world, not just in the US, they share one common trait. People that are persuadable, people that are swing voters, are largely cast on the basis of how they feel about their economic prospects. So if you could get the economic prospects right, you could generally predict elections. That's true in the US, true in the UK, true all sorts of other places where you have developed market data. So in the United States, the way I did it, I'll let you in on my model, was you would take the swing states, and it's changed a little bit, but let's use the current swing states because it really is the only ones you need to get right. Is Pennsylvania, my home state, Wisconsin, Michigan, the three northern tier states. And in the last couple cycles, the three southern tier states, Georgia, North Carolina, Arizona, and you can throw Nevada in there, maybe as one that kind of swings. So that's 7 states. So if you look at the economic data within those 7 states and you get a sense of the economic electorate, their state of the electorate, plus you look at state level polls, not national polls or not national pollsters, but think like in the Iowa caucus, the Des Moines Register poll, a very reputable, accurate poll. So if you take those two things, state level economic data and a subset of polls, the most narrowly defined, and you look at the trend in that polls and the state of the economy in those battleground states, you can predict elections with really high efficacy. That's always been the approach. That's how I did it. That's how I got all of them right, including Trump in 2016, which was largely a lot about the Pennsylvania electorate, the state of the economy there, and the shift in the polling, the trajectory. Not that Trump was ever leading in the Pennsylvania polls, but his trajectory was very much changing in the last 8 weeks. Okay, that's been my tried and true method, and it's always worked. But the challenge is things are changing. So Craig Columbus's electoral model will no longer work in the same way it did. And that's because the electorate has become so hyper partisan. And I say that because there's something called the University of Michigan Consumer Sentiment Survey, where they talk to people about how they think about the economy, what their expectations are for inflation, all sorts of interesting things. But they break it out based on registered Democrat, registered Republican, and independent. And that data goes all the way back to the 1970s. And when you study it, you see something has dramatically changed, particularly in the last 5 years, as you get COVID, hyperpartisanship, social media, echo chamber, all those things that are part of our culture, what they would call the fourth turning, some people would call. And what you see is that people no longer, my model worked because people would vote their pocketbook. Are you better off, John, than you were 4 years ago? If you could get that question right, you could answer the question. Now, people don't think of it that way. They now view the economy through the lens of politics. Okay? It's flipped. The swing voter is not in the same regards. And by say that, when you look at that University of Michigan Sentiment Survey, the view of how you think about the economy is largely based on your partisan politics. So I'll give you an example. There's just took a poll within the last couple of months of registered Republican voters. Over half of them thought the S&P 500 was down more than 20% on the year. More than half. Okay, the S&P 500 is up 19% on the year. More than half thought unemployment was at a 50-year high. Unemployment is at or near a 50-year low. So my point is, you see the economy the way you see politics. So my method for predicting is no longer as sure. But what I will tell you this, the lesson is, and we're going to talk about the politics in a second, is investing on the basis of partisan politics is a very bad, not only investment strategy, it's bad for your health, your psychology, for your heirs, all of those things, because markets can work in any political party. They operate independent of it. And so what I worry about, look, I'm all for advanced citizenship. Vote, contribute, organize, protest, form a PAC, do all of those things. It's great. Just do not do not invest on the basis of your political views, because it is not an accurate barometer, right, of all the things that drive markets. I'm not saying policy doesn't matter. It does. We'll talk about that in a second. But things like earnings, interest rates, all those things, far more important. So please, let's just set aside the partisan for a second, and we'll talk about it. But I think that's an interesting way to think about politics. predicting it is nowhere near what it was just 10 years ago. I could nail Trump in 16. I could not tell you with any degree of certainty now how I would do it. I'm not a strategist anymore, but it's a lot more complicated. Okay. So let's talk about the events of recent. Let's set aside all of the subjective views of it, right? Because that's irrelevant for our discussion. We're just thinking about the economic implications, the financial and economic implications. When Trump's prospects went from lean Trump to, in the betting markets, much greater prospect for Trump's victory, right? Post the debate, post the convention, all those things like that, behaviors started to change in the market. And by that, I mean, things you could see were changing. It was like people were dusting off the 2016 playbook. Because after Trump won in 16, what you saw was that the cyclical stocks, the industrial stocks, things that domestic manufacturing stocks, those all, and small cap, all started to get a bid. They started to get interest from investors. So we saw the exact same thing here. There was this interest in like domestic manufacturing, steel that would benefit from Mr. Trump's proposed tariffs, things like oil and gas that would benefit from deregulation, health insurers, credit card companies, regional banks were up like 20% on the month because there would be a lighter touch about consolidation among regional banks, lighter touch on M&A activity, coal, anything that would benefit from sort of new or drilling rights, a corporate tax rate that in two recent interviews, Mr. Trump said he would prefer that you would go from 21% on the current corporate tax rate to a 15% corporate tax rate, renewing the Trump tax cuts that passed in 2017 that would expire in 25, and on and on and on. So that playbook was dusted off and it was brought to the fore. Now, the bond market, interesting question, because what the potential risk was is a potential risk of higher inflation. Now, why? Well, because one, you're talking about tariffs. So 60% tariffs on China, a 10% across the board tariff on all other trading partners Mr. Trump has talked about. And presidents do have pretty broad power as it relates to tariffs. That would potentially be inflationary, right? Because it would be a higher tax on import prices. And potentially, Mr. Trump would like to run the economy hot. He would want to pressure the Federal Reserve or exert greater independence on the Fed to keep rates low. The labor force, if you took a tougher stance on immigration, remember we've had an influx of migration, regardless of what you think about it, it has helped stem the supply of labor, or improve the balance between the supply and demand of labor. But all of those things, those policies could potentially grow in greater inflation. And so what you see is a steepening in the bond market where the shorter term, you would the shorter end of the curve would go down and the longer end of the curve would go up in response to a greater risk of inflation. So that's, I guess, what you'd say Trump trade number 2. Some people call that the debasement trade, loose fiscal, low tax rates, the kind of the higher tariffs that could have an implication on rates. And then there's the dollar, right? So if Mr. Trump has said he would like the dollar to be weaker, he said that the Japanese and Chinese in particular have artificially suppressed their currency. So you'd want the dollar to be weaker. Mr. Vance, big advocate of weaker dollar too, because that would benefit a U.S. exporter. The domestic manufacturer exporting abroad would benefit from a weaker dollar. And so the idea is that you could lean on countries to accept dollar depreciation. The challenge with that is that's a policy, but if you have higher tariffs and you have immigration control and you have deficit finance tax cuts and you run the economy hot through monetary policy, you're likely to get more inflation, which means the Fed would likely keep rates higher so the dollar could strengthen. So I don't know what Trump policies would mean for the dollar. I think markets are trying to trade it both ways. They certainly are trying to trade the equity portion of that. the cyclicals, the industrials, the energies, the financials. The bond market is trying to understand, is there inflation in there? Would that cause the curve to steepen? And then the dollar, he wants a weaker dollar, but some of his policies would actually produce a stronger dollar. That's the best summary I can give you of the kind of the Trump policies. And one kind of final one, which I think is sort of fascinating, is this idea around cryptocurrency. So as you may have seen recently on the campaign trail, Mr. Trump has said, we are going to make the United States the Bitcoin capital of the world. Now, that's a big reversal from Trump when he was in office, said, crypto, Bitcoin was kind of a scam. But he's flipped, changed his, some of that is a nod to younger voters, particularly younger male voters who tend to be a very strong advocates of cryptocurrency. Mr. Vance himself on his FEC report reported that he owns between $100,000 and $250,000 of cryptocurrency. Mr. Vance's patron, Peter Thiel, coming from the venture capital world. So obviously he's tuned into that community. A lot of large crypto donors have expressed support for Mr. Trump. And the idea that we would mine crypto in the United States, and in fact, Trump even went so far as the other day to say that we should establish a strategic stockpile of Bitcoin. The United States Treasury should think of it like the Strategic Petroleum Reserve, a strategic reserve of cryptocurrency that could offset some of the debt burden in the United States. So that's a very, and he has said he would replace the SEC chairman in favor of kind of a lighter touch or more deregulated approach on crypto. Fascinating, because it's such a change, but it's also good politics, given how much crypto legitimacy has changed. And in fact, I think both parties now, including Mrs. Harris, are trying to think about a more pro-friendly, pro-regulatory approach to the whole industry, in part because the industry is exerting a lot more influence. It has a lot more political clout. It has a lot of dollars behind it, and politics and dollars go very close hand in hand. So all of those things, I think, are the political calculus at the moment. Last thing on politics, and we'll pivot. Obviously, Harris, more of a blank slate. We don't know as much. Coming from some exposure in Silicon Valley, likely a continuation of many of the Biden-era policies, which have been pro-onshoring or domestic onshoring of certain industries, key industries like semiconductor, for example. We are onshoring a lot of that kind of domestic manufacturing or clean, and some of it related around clean energy. But a lot of investment in factory infrastructure in the United States at a level like we haven't seen in years, really running 3x what was seen in years in what they call manufacturing structures. Big investment in that, and so I think you'd likely see many of those policies continue. Probably would not want to push for the renewal of Trump tax cuts, which expire in 2025. But we know less about Mrs. Harris's policy, but that obviously is going to take its shape over the next 3 months. So I'm going to stop right there and say, does anybody have any questions they want to ask about the politics or market impact or market or economic impact from either of these two candidates?
Now's a good time. I know it's a small group. Think of it like a small town hall Q&A. So feel free to ask a question on the topic that you guys have just heard if anybody has anything. And if not, we can keep rolling. Go ahead and unmute
Okay.
and just.
And by all means, send me any questions that you have after. We can talk about it for sure. Okay, so that was pillar number one, which kind of caused some of this seismic shift. And then the second thing was what I laid out at the table was the economy. Still very much in this soft landing scenario, which is the economy. Soft landing is the economy slowing. So we grew at the first estimate of second quarter GDP was 2.8%. But certainly not re-accelerating to reignite inflation, but not falling out of bed either. So economy doing exactly what the Fed would like, a nice soft landing, and inflation starting to abate at a nice clip, getting much closer to their target rate, their 2% target. And in recent months, you start to see some of the stickiest last mile components, particularly around rental inflation, which is the slowest one, really starting to improve. Rental inflation feeds into core inflation. So the Fed now has cover, if it wants it, to begin a rate cutting cycle. And I certainly think that the economy is holding up, but where the Fed runs the risk now, remember, it hiked rates for a year and a half. It's been on hold for a year. It runs the risk now of staying too long because remember, other central banks around the world have already started to cut. So the Fed usually is the bell cow of interest rate cuts. It cuts, everybody follows. Now, most of the other developed central market investment banks, central banks have been cutting, but the Fed is still on hold. So one, they run the risk of being behind the curve. Certainly lower income Americans are struggling. They are struggling, and you see that in the consumer sentiment surveys, whereby it's like at an 8-month low because lower income Americans struggling still with high grocery prices, mortgage affordability. You all in California know the issue of mortgage affordability very, very well. High credit card interest debt. So the Fed runs some risk there, right? These things are working with a lag. The savings rate is getting spent down, and you're starting to see unemployment tick up very slightly. It's almost like leaking, like out of a balloon. But the last 3 months, unemployment has been leaking higher. Certainly not some red flag flashing, but unemployment, once you start to get in a directional trend, it can go pretty quickly. Now, given the level of immigration we've had in the country, given how tight certain labor markets are, I don't know if that's still true today. Every cycle is different, but I'm saying the Fed has some rationale to cut here, even though the economy is not falling out of bed. So a couple points on the economy. Why, given the fact that the Fed hiked so aggressively, and those hikes typically work with a lag of about 6 months to a year, so we should have already been seeing effects from it. Why hasn't the economy really hit the brakes given the level of pace of hikes that we had? Now, these are just theories. They're theories that I don't know the answer. One is the level of government spending has been extraordinary. So if a $30 trillion US economy and the federal government is typically, well, let's say what it is right now, 21, 22% of spending, that's very high, very high. So to find the level of what we are spending right now, you really have to go back to World War II, 07, 08, COVID crisis. In other words, we are running crisis levels of spending that you typically in an economy that has been pretty good. Low unemployment, reasonable growth. The economy's grown for 7 consecutive quarters, but we are running recessionary type of spending. Now, we can argue about the public policy of that. We can argue whether the dollars are being spent the right way. The current administration would say we are spending on things like domestic manufacturing. We are onshoring the United States semiconductor industry. We're reducing our dependency on unfriendly competitors, all those things, but it is what it is. The government is spending at very, very high levels, and that has supported the economy. That's one that makes perfectly good sense to me. The second one is, well, during the pandemic, the COVID crisis, many people refinanced their mortgages. So they're far less sensitive to interest rates than in prior cycles. Very true. Okay, you don't have those same variable rate mortgages like you had in 07, 08. Now you've got a lot of people locked in very low fixed rate mortgages that prevents you from moving. It prevents housing mobility, but it makes affordability pretty good. That makes perfectly good sense to me. The fact that we've had this high level of immigration in the United States has boosted consumption. That makes perfectly good sense to me. Now, it comes at a cost though, right? Because some of that consumption has meant you've pushed up inflation for rent in particular. You've got a lot more people looking for rental housing, things like that. So it's not without its cost, but that one makes sense to me. The fact that you had COVID revenge spending. So people, revenge spending, meaning I sacrificed during COVID, I didn't go on a vacation, but now that I feel more comfortable with my health risk, etc., and I've realized that life is short, I'm going to go on a trip to Europe. I have 3 different friends who are all taking their kids to Europe to see Taylor Swift because it was too expensive in the United States. Because the idea was, and it's a true story. A friend of mine was like saying, well, I can go to London to see Taylor Swift for $500 US, but when Taylor Swift was in New York, it was $2,500 at the Meadowlands. Obviously, these are first world problems, but my point is, I do think people's behavior, anybody that's been in an airport this summer knows people are still traveling and spending. The last thing is this kind of, or two more things, the boost in wages. So particularly lower end workers have gotten a nice raise because the shortage of workers, it's more competitive, higher minimum wage laws have been enacted. And the point is that now you have more disposable income. Yes, you're straining under high food prices, high gas prices, high rental prices, but your real income has gone up, or your income, your wages, particularly for lower income Americans, is going up at a faster rate than the rate of inflation than it has in prior cycles. Okay, that holds the economy together. And then the last one is you all. I mean, I'm blessed. I represent the interests of savers. And savers have really benefited from the fact that short-term interest rates are money market rates are, let's call it 5.25. So let's make it real. So before the pandemic, let's just go back to right before the COVID crisis, the fall of 2019. We had basically zero interest rates in the United States. So you were blessed enough to have $1 million in the bank. You were earning $1,800 a year in interest. 18 basis points, $1,800 a year on your $1 million. Now, fast forward to the last few years, you're blessed enough to have $1 million in the bank. Now at 5.5%, now you're earning $55,000 a year on the same $1 million at basically risk-free rate. That supports consumption. So for all those reasons, despite the fact that it's having very aggressive rate hiking cycle, we've had the fact that we've had a very high level of government spending, extraordinary given the times in which we're living. Most people refinance their mortgages, locked in at very low rates. Immigration has boosted consumption. We've had a high level, still revenge spending going on after the COVID brush with all of the difficulties that brought to our society. We've had a boost in wages for lower income Americans, and the saver class has really benefited from high short-term interest rates, which has supported consumption. Put all that into a bag and you realize, hey, that's how you get a soft landing, despite really high interest rates. So I think the Fed is at an interesting time, though. It can't get locked behind the curve. It really does, in my personal opinion, need to cut rates. Doesn't have to do some super long cycle. I think if we have 2 to 3 cuts, that would probably do it. That would be appropriate. You got to get that real rate down, because if you do nothing, right, if you do nothing, if you just sit here with rates at high, very high short-term rates, and inflation continues to fall, right? Inflation is falling while the short-term rate is anchored up here, the funds rate is anchored. Well, that's like a form of tightening, right? It makes money more expensive, what they call in real terms. That's like a de facto tightening. So the Fed needs to get those rates down, and I think we should see that in the not too distant future. So last point, and then we'll be done. So what happened with all of these factors kind of lining up during the month, we saw this fascinating rotation in markets. So as you know, for many, really not just since the rally off the bottom last October, but for multiple years here, the leaders in the United States have been these big tech stocks, the Magnificent Seven, these mega cap tech stocks. And since the bottom last fall, AI, anything artificial intelligence related, like semiconductors that power AI, the data centers, all those things really benefited. But because we've had potentially a more imminent rate cutting cycle, the Fed's going to start cutting rates. Now people say, well, maybe I should start looking for trades that benefit more from a lower interest rate environment. And I'm going to start rotating. Oh, and by the way, right on the doorstep of that, Trump's prospects went up a lot in a short period of time, and that lined up with some of these same cyclical industrial value trades, and so there was this violent rotation in a very short period of time. So that's how you got like almost a 20% move in regional banks in 1 month. The interest rate sensitive things, financials, real estate, and then those more cyclical value kind of names, And what you got was breadth really improved, and that's a healthy thing. So rather than being so narrow, like a handful of mega cap tech stocks, now the rally has started to broaden out. Other sectors, other stocks starting to participate. That's a good thing. So the percentage of stocks in the New York Stock Exchange above their 200-day moving average rose this past month to the highest level during this entire bull market cycle. The advanced decline line, another measure that made a new all-time high. So I think that kind of sector rotation is actually a positive thing. Those mega cap tech stocks, really rich in valuation, really momentum driven. Now the market's starting to broaden out. And the most classic example of that broadening out, which was left for dead by the side of the road, was small cap stocks. So small caps have had an extraordinary surge during July. So they benefit from this rate cutting expectation. So as soon as it looked like, oh my gosh, there's a great likelihood of a Fed rate cut in September, small caps started to rally because they're more interest rate sensitive. So unlike the mega cap corporation that can, borrow at really attractive rates, many smaller companies have floating rate debt, right? So that debt is more sensitive to changes in interest rates. So if rates start to come down, they would benefit. Many of those small cap companies, they also benefit. When was the last time small cap started to rally like this? Right after Trump got elected in 2016, because the idea was that he would be focused on these tariffs. It would maybe benefit more domestically focused companies, companies that were focused more on, most small cap companies don't have a big international presence. Many of them are banks, so they benefit from looser regulatory footprint, more consolidation, things like that. And so again, the stars aligned in small cap. So you say, well, how good? And what do you mean by extraordinary? Well, this. So the Russell 2000 staged during July, just within the last 3 weeks, its best ever 5-day period relative to large caps. So small outperforming large over a 5-day period at the best time in the history of the data set, which really goes back to 1978. And it had its best outperformance, small over large, over a 3-week period in the history of the data set. So that's pretty good. And it just shows you that this rotation that I talked about, where the stars aligned, these two forces lined up to cause this shift in rotation and a broadening out in breadth, which I ultimately think is positive and constructive. Well, that's how it ended up, right? And so we end up at this kind of really interesting point. You typically, and I'll stop here. You really tend to get now from this period through that September-October period, markets kind of trade down to sideways. They digest these gains. They try to figure out the uncertainty. Election years tend to be pretty good, but where you get your last part of that relief rally is mostly after you get clarity from the election. So we'll see now that the race looks a lot more like a toss-up. The odds have reversed as Mrs. Harris has gotten, or Vice President Harris has gotten her boost. Now some of these Trump trades are being unwound, and now it'll be interesting to see how those polls, if you get a little bit more of a sideways trade here, as it looks like a less clear-cut thing. I don't know if markets are as concerned about who wins as they are about sort of who controls all the levers of government. So I do think that's kind of an interesting point. And it was looking very much like all the levers of government could be shifting one direction. So it really comes down to, you need a House, you need 218 votes. In the Senate, you need 51 votes. The Republicans have a very favorable Senate map this time. They will pick up West Virginia, likely Ohio's in play for them, Montana's in play for them. So there is a chance that you could get a very consolidated government sweep, and that would potentially result in those higher yields because there would be less legislative pushback against some of that sort of more pro-fiscal, pro-tariff kind of policy. I guess we'll see. So keep an eye on those congressional and Senate elections. I think for markets purposes, they are as important as the presidential election itself. Markets just want clarity. Again, I will say in my concluding remarks, markets can rally under Republicans, markets rally under Democrats. It is not a way to bring that into your investment decision making. I know you all have worked with Chris for a number of years, and you do best practices, right? You have diversification, you have multiple kind of asset classes that can work under different environments, and that's really the best class. Chris is as good of a financial advisor as I've come across in my 30 years of doing this, and that kind of approach will serve you very, very well, rather than any kind of emotional response to elections. Okay, I'm going to stop there. Brian Wright is here, and he can speak to any questions that we might have about the yield select strategy. You know what, Brian, why don't you give him a couple minutes just to talk about that environment? We talked about cyclicals, about the shift away from mega cap tech, and maybe how that could impact global income. Yield select.
Sure. Thanks, Craig. Yeah, so I mean, just to maybe quickly review what exactly Yield Select is. We've been managing the strategy for well over a decade. I know a lot of you on the call have been in the strategy for a long time. So here it's a balanced approach. So we own stocks and bonds in there, similar to like a 60-40 type portfolio. On the equity side, we're looking for stocks with above average dividend yields. So specifically trying to generate a higher level of current income. And we're really trying to focus on, I know Craig mentioned the value factor. So it's the idea that historically stocks which trade at lower multiples to earnings, price to earnings ratios or price to book ratios, over the long haul have tended to generate a little bit of excess returns. That certainly hasn't been the case the last 18 months. But historically it has been true. So we're trying to get access to kind of that value factor, but do it in a targeted way by targeting dividend paying stocks, which also have strong balance sheets and kind of strong profitability and quality characteristics. So we think we can get value exposure in a little less volatile way than just going out and buying some broad value index. And we also get global exposure. So that's how we kind of view it. I know Chris uses it this way, is as a diversifier, as part of a broader portfolio. And where you can generate certainly solid absolute returns, but during periods where large growth stocks struggle, we certainly saw that coming out of the tech bubble back in the early 2000s. Saw it in 2022. This type of strategy can be a very effective diversifier. Kind of it zigs when other things zag, and especially now the S&P 500 is very heavily concentrated in growth stocks, more so than it's really ever been, other than maybe the very peak of the tech bubble. So S&P 500 is going to move with those large cap growth stocks. So something like this just provides very effective diversification that we think, again, is going to do well over the long haul. Last point, a lot of these stocks haven't done, haven't had the huge gains the last couple of years. So even though the S&P 500 itself looks kind of expensive or very expensive on certain metrics, these types of stocks really, really don't. Dividend paying stocks have lagged quite a bit the last 18 months. So, really they look pretty attractive on valuation metrics, and here valuation is really not a concern at all. If this broadening of the market continues that Craig spoke to, we think this is the type of strategy that would benefit from that. Some of these stocks which haven't participated as much on the upside recently, should benefit from kind of a broadening out beyond those magnificent 7 mega cap tech stocks. So that, we'll open it up to questions. And
that's great. Yeah, Chris, by all means, please, let's take any questions that the audience has.
Sure, that's great. There is one question in the chat I'll read in a minute. There's another one that just posted, which we'll get to in a second, but feel free, you guys, to use the chat as well while we're speaking. I want to take a quick moment just to say I did a horrible job introducing Craig and his team, and I just wanted to take a minute and give you a little bit of a background and history. But Craig and I have known each other for a really long time. Like he said, oddly enough, I think probably we would go back maybe a couple different companies where we used to work together, and I just really loved what he was doing so much in the management space that I kept in touch with him, and he and his firm have continued to be one of the investment strategists that we continue to utilize for a core purpose of some of the retirement accounts that we do. But it's been a great relationship, like he stated. The name of the company is Columbus Macro, and the strategy that Brian was alluding to, we just call it Yield Select. It's really, like Brian mentioned, this global, dynamic, balanced dividend strategy, if I'm saying that right, guys. But we utilize it a lot for either the middle bucket or sometimes the later bucket in the appropriate space as a diversifier, get some global exposure on things that are going to be assets that are going to be better valued at the time. Sometimes that sort of investing can be very difficult in times of roaring markets and other asset classes, but staying disciplined is a very important part of investing. And it's been very consistent and worked well for us in a number of different ways. The dividend yield on it is still strong, and the valuations are still really nice. So just wanted to mention that. The other thing on your end, guys, I've actually grown the team. It isn't just me. There's we have 6 advisors now altogether. So you may be joining us either now or on the recording on behalf of the somebody other than myself that you're working with, and some of the advisors are on with us here today. But sure, there's a couple of questions here. The first one is going to be, what is your view on the BRICS expansion and potential Mexico inclusion?
So first, I should have made a much broader nod to your team. My bad.
No, I didn't.
Obviously, you and I have such a long standing, but you have some really
I didn't mention it early on, and so
you have some
we normally
terrific
have a
colleagues.
slide where it reminds me to put all that on there, but I got a little lost in the lack of initial intro slides myself, and that's why I think we kind of started off it just right off the cuff, which is great. It's kind of low key town hall style meeting, which is fantastic. So just my fault on my end. No needed to apologize. Go right ahead.
Yeah. So the BRICS question is an interesting one post the Russia invasion of Ukraine. Obviously, the way emerging market countries interact with each other has changed as they sort of shift away from sanctions and policies like that. I do think the tariff question has something to do with BRICS, right? Because if you know anything about the way onshoring has worked, or reshoring, or friendshoring, or whatever term you would like to use, nearshoring, in order to evade tariff X, the Chinese in particular have invested a large amount of manufacturing muscle in Mexico as a kind of as a policy, as a way to sort of near shore, and you're sort of trying to evade those tariffs. So Mexico as this destination, as this nearshoring destination to the United States, has become was a very popular market last year. Obviously, they had a presidential election in Mexico, the first woman ever, and some of the air came out a bit out of the Mexican market, but it had attracted a ton of investor interest as it was viewed as the nearshoring capital, and so it had a bigger role to play on the national stage, on the international stage, on the BRICS stage. So I think it's a fair question. I think Mexico's clout is certainly growing in its import, and that how those tariffs are enforced, I think will have a lot to do with the way Mexico sort of evolves on that stage, for sure.
Okay, great. Thank you. And again, if anybody has a question, feel free to type in the chat, or in a minute, you can just unmute yourself and ask. I'm going to ask the other one that's in the chat here by Arcadia. With government spending as high as it has been, and the fact that it has incurred such a high debt from this spending, how can the country maintain this debt? Do you see taxes increasing? How do you see taxes will be increasing depending on who is in the office, and how will it impact the middle class?
Yeah.
In there,
so the greatest question in macro finance: when do deficits matter? When do you hit the wall? Because it's the hardest question to answer, because there's very little empirical evidence. The only thing I can tell you, there is a fascinating case study going on right now in Japan. Japan, the most indebted of the industrialized countries in the world, running a massive deficit. And for years and years and years, the Japanese didn't have any inflation. It had to do with the way they're at a very low level of immigration. They had kind of very closed economic system, very little deregulation. So very few wage increases. So inflation was non-existent. And the Japanese have been trying to get inflation up. So Japan, the opposite of the United States and Europe, trying to get inflation down, Japan's been trying to get the inflation rate up. And they've actually succeeded in doing it to some extent over, and the Bank of Japan is actually meeting this week. They've actually succeeded in doing it by making their currency weak. By making their currency weak, by keeping your interest rates artificially low. They had zero interest rate policy for for a long period of time, while other countries were raising, like the United States. So you had a huge interest rate differential and the yen was weak. And by doing that, you helped to import some inflation. So Japanese consumers wouldn't howl too much because it was not at a level that was so unwieldy. But the fascinating thing along the way is by becoming so indebted, the question is, can you stop? At what point does the currency become out of your control? So the Bank of Japan has been sort of looking at its currency devaluing, which policymakers have wanted, and it's sort of been saying, you know what, we want it to be orderly, but there's all these, short sellers, what they call carry trade, borrowing in yen to invest in something else because the yen has a very low yield or interest rate on it, has been one of the most popular trades in the world, but it can get out of control. So they've been trying to intervene. And every time they try to intervene to defend their currency or keep it from falling too far, they've failed. It's almost like they get steamrolled by the market. And the lesson of that is at some point, deficits matter. And where they start to matter is they leak into other areas. And where they leak first is into currency. They leak into currency weakness. So in the United States, we are nowhere near at the level of Japan. It's one of the reasons why it's very important to be able to borrow in your own currency. So whenever people say like, oh, who cares about the role of the dollar? Believe me, as an American, you really care about the role of the dollar. And I don't think the dollar is going away anytime soon. It's important to be able to borrow in your own currency. It helps you from a sort of a deficit finance management perspective. But I will say where you start to see it leak into other areas. There's absolutely no political will on the part of either one of these parties to do any kind of deficit reduction. And in fact, when I first started in the business and I was working on public policy, there was in both sides of the aisle, there were sort of deficit hawks. There were people that were Rudman, Graham, there was a series of people on the Senate side in particular. They're all gone. There's nobody is a deficit hawk anymore in either one of these political parties. And in fact, they have no interest in financing anything other than through deficits, whether that's tax cuts or more spending or more infrastructure, not at all. When will they ultimately get religion? I think ultimately when the bond market gives them discipline or the currency market gives them discipline. And so when that happens, your guess is as good as mine. I just don't think it will come from voter, especially because as post the pandemic, people, this is true around the world, have gotten very accustomed now to government intervention during recession. So next recession, if we have one, be looking for that stimulus check to go right out, and that check gets spent immediately. There will be cries for that again. So don't look for the electorate. Politicians don't even talk about it. It's non-existent. Where it will come from is currency or bond market. What day or when that happens, I don't really know, but I think we should hope that that's where the disciplining mechanism takes place. I'm sorry, I wish I could give you a more definitive answer, but all I know is where it will likely come from, not when.
Great. Thank you. As you can see, Craig's one of the smartest people I know, and so that's why it's always great to take advantage of these questions when you have the opportunity. I know I've heard him field many over the years. If anybody else has a question with that said, please feel free to either unmute yourself, and I don't see anything else in the chat.
Craig, or Brian even, what impact has events in the Middle East played on specifically like the Yield Select program, if any?
Well, I'll let Brian answer it from a portfolio construction perspective. I mean, it is a very heavily valuation driven strategy. So it's looking for intersection between valuation and yield. So macro politics not as important, but I'll let Brian address. Obviously, it's had some impact on energy markets. There is some energy exposure in the portfolio. I'll let you address it from a portfolio perspective, and then I'll talk about it from a policy. Okay, Brian?
Yeah, it's an interesting question. It's probably to this point had less impact than you would expect, primarily because we just haven't seen any, big disruption in the energy market. If it expands beyond, obviously the current conflict, especially if there's a broader regional conflict that involves directly Iran, you certainly could see oil prices have a very big move higher, which would have, a pretty significant impact on everything. And then the other thing where you do see some impact potentially is in cargo shipping rates, that the cost of shipping goods, especially from China across to the West, have spiked. And there's the continue to spike. I mean, part of that is because of the Middle East conflict. There's been attacks on cargo ships in the region, so they're taking longer routes. Insurance rates have gone up, but you also see some speculation separately that because of the potential for tariffs from Trump, especially, companies have started to try to front run that in sort of pre-order inventory, which is causing demand for cargo ships to rise. So that actually has some inflationary impact. So I think ultimately, if there's going to be a big impact in terms of the economy, it would probably be on the inflation side. We haven't seen that yet, really broadly speaking. If that were to happen, we in our sort of inflation models pick that up, we would look to shift a little more into inflation protected bonds and make some adjustments. We do have just value in general. It certainly includes more cyclical things, materials, energy, which tends to benefit from higher inflation. There is some exposure there, but certainly we could increase that exposure if that seems to be playing out.
Yeah, I think you make a great point, and I'm sorry I didn't mention that, but that inventory pull forward, as markets or companies or CEOs think, and we already started to see some of this, that a Trump victory was more likely, in order they tried to front run those tariffs. And we saw that before, but now he's talking about much more draconian tariffs than in the prior administration. The 2016 administration. So you are seeing kind of a pull forward of inventory, which will be inflationary. It would actually give a boost to the economy in the short run. There will be a price to pay, and ironically, it would be in the economic cost would be in the Trump administration, because you'd have to work down those inventories that you're pulling forward into the current quarter. The other thing I will say on shipping is a fascinating point. If I was thinking about all the things in my lifetime, macro things that have changed, and I was making a short list. On the list, I don't know where it would land, but on the list would be the power of the seas. So ignoring this Middle East conflict has so many different complex layers. But one of the macro impacts now, the economic impacts, not from the humanitarian impact or the moral impacts, and then all that aside, is the United States controlled the seas. We just dominated the seas for 30 years, and we basically controlled shipping. But with these drones, like you see these Houthis, I mean, these are a ragtag bunch of undisciplined, not very sophisticated fighters. And what you see with these drone attacks is you really can challenge the power of naval supremacy, which is a very fascinating question for go forward. And once you make these drones even more lethal, and you saw that and that's really what the Ukrainian conflict is. It is a proving ground, a testing ground for the lethality and targeting of drones. Because now you see, you and I used to the human mind and what it can target. Now, when you start using artificial intelligence, it has a targeting package thing of so much greater than any time in the history of the world. You can target, you're scanning thousands of targets at a pace that you never could before. Now, once you start applying that to drones, you can be a very, very low tech military force, and you can really interrupt the power of shipping. And so I do think sort of power or naval power and how you deal with that is a huge issue, because it affects what we just talked about, the route of shipping, the cost of shipping, which then bleeds over into higher inflation and things like that on a go forward basis. It's one of the reasons why I think, are we in a higher inflationary regime for the next 10 to 20 years? Yes. Now, I mean, obviously not the runaway inflation that we had, not the 9% CPI, but are we going to go back to sort of a very zero inflation? No, I think we are going to settle at a level that's higher, in part because of these kind of disruptions.
Thank you.
Okay, Chris, I think we're probably out of time, and I went too long there, but thank you for indulging me.
No, you're great. Thank you for your time and your team. Brian, thanks also for your insight. Also, one of the smartest people I know, I should have said, if you can hear as well. Obviously, I have a lot of more questions I might be able to ask you on bonds and all these other things with rates cutting, but let's talk another time. Thank you again, and we will see you next time. You guys take good care. Thanks for being part of our extended team. I appreciate all you do, and we'll circle back if there's any questions from any of our clients down the line. Thank you. Be well, everybody.